Well, the AI crash is upon us. It was just 5 days ago that I posted, beware the huge coming AI stock crash, and it has officially begun. And most of the last 5 days have actually been the weekend, and now we're looking at, Nvidia's down 5.6% on the day. You've got most AI plays down. Supermicro down 13% after being down 20% on Friday. Shorted that, made a 3.7x. That was pretty good on some 0 days. But you've got most of the market selling off here. A lot of it being tech-based. Why is this happening? Why is the market going risk off? Well, the market always goes risk off after being at extreme greed. In fact, on Friday, we were at a level of extreme greed on the greed and fear index. This is generally a perfect contrarian indicator. And I guess I shouldn't say that there's anything that is a perfect indicator because that's not true. But then again, when we had SMCI add an RSI of, take a look at this, 95 at one point, 96, a level we had not seen in a stock since GameStop of January of 2021. It was only a matter of time for the stock to essentially correct. And that's exactly what's happened. So why is this happening? Well, it's very simple. So if you're wondering why is the stock market crashing, here's the very simple answer. First, tomorrow we are going to get the Federal Reserve's FOMC minutes. This is where the Federal Reserve gives their curated summary of what was said in January at the Fed's meeting. Now, they have the privilege of updating that summary for about 3 weeks after their meeting, so they get to sort of tell the world what they think. And if they want to start indicating, hey, maybe there's a chance we're going to have to raise rates again, Treasury markets are going to sell off, yields will go up, and generally risk assets will go down. So given that today is the day before the FOMC minutes release, which comes out 11 a.m. Pacific time on Wednesday, it's no surprise the market is a little skittish. But it's not just the Fed, because remember with the Fed, we've got, as we've written over at ehack.com, by the way, we've got some real good updates getting in on to ehack.com. What do we have? 37.8% chance of a cut in May, 61.9% chance of 4 cuts in December. Mind you, this was almost guaranteed at the beginning of the year. In fact, we were pricing in 6 to 7 rate cuts at the beginning of the year. Now we're barely pricing in 4. In fact, we're not even completely pricing in 3 cuts by December. Why? Because we just had a hot CPI number in January. Canada doesn't seem to agree. Canada's CPI came in lower than expected in January. And a lot of folks look at Canada and say, well, Canada and the US, their inflation rates, they tend to align both on year over year, core and core. The numbers tend to align. You tend to have this decline. In this chart, for example, we have Canada's year over year in blue, the US in blue and Canada in white right here. And so you see this alignment. So it does give some optimism that maybe January in the United States was just an abnormality, some form of crazy, weird seasonal adjustment, but it's still creating fear that the Federal Reserve tomorrow is going to be forced to tell us, I don't know, maybe things aren't as good as we thought they were, and we might have to price in another rate hike. So that's the first thing the market is doing right now. So you're going from a place of extreme greed to less greed and a bit of a sell-off because there's fear that, oh no, those January jobs numbers were strong, PPI numbers strong, CPI numbers strong. Maybe if everything's reanimating and consumers are spending more money than we expected, partly because credit standards are actually falling. In other words, more credit is opening up and becoming available rather than less. Both true for industrial and credit cards, which basically mean maybe people can continue to spend, which is unsustainable in the long run. Eventually that blows up. But in the short term, it's kind of like, the economy's hotter, then maybe we need to push that greed thing back a bit and actually tighten more, which means we're not actually at peak rates yet. I personally don't think that's likely, but that's what the market, at least to some percentage chance, is pricing in. It is a non-zero chance that the Fed has to raise rates again. Now, again, I don't think that's likely, but I do think it's likely that we might be waiting until June for rate cuts. which isn't fantastic for risk assets, though the stock market is really good at trying to pre-price in what the Fed will do. In fact, I argue that the Nike swoosh that we've seen over the past, well, quite frankly, year and 3-ish months here that we've been talking about coming, this Nike swoosh that has arrived, which has been correct, is likely pre-pricing in eventual rate cuts. And so that's why, even as we're sort of teetering on, oh, are the cuts going to come in March? Or no, it's not March, it's May. Oh, no, it's June. That doesn't matter so much. We know they're coming, or at least we expect that. And so that's why in the last 24 hours here, some concerns over, well, what if we're not at peak yet, is leading to some form of a risk sell-off, or risk-off sell-off, another way to phrase that. So that's one, right? So the Federal Reserve and concern about the Fed, are they done? It's not so much about when, it's just that is when the cut comes. It's more, oh my gosh, what if we have to go even higher? Keep in mind, treasury markets right now, you're sitting at 4.24 on the 10. You know, a month, 6 weeks ago, so right at the beginning of the year, we were sitting at 3.8. Okay, so we're up 45 basis points on the 10-year. That's a lot. That's a lot of extra cost. Especially hurts interest rate sensitive plays. So one of the reasons you've seen a lot of the interest rate sensitive plays just get left behind. Even though there's no recession, the interest rate sensitive ones are acting as if we're in a recession. In fact, quite frankly, a recession would almost be better for the interest rate sensitive stocks because then rates would plummet. Kind of ironic. But what's the second thing that's happening? Well, it's Nvidia. Of course, Nvidia earnings are tomorrow, which is a big deal, and markets like to say, all right, look, Nvidia stock, you continuously get rejected at the 730. You tried to break out 3 or 4 times. You couldn't do it. You just couldn't pull it off. This is the week chart, mind you. Look at this. It's almost perfect. You could not get a single candlestick to close fully above the 731 level. And so now the classic fib retracement levels are working again. We saw this coming. We talked about it. And this is why I made my video last week. Not only because of the resistance that we're facing here, but also, well, frankly, because what is NVIDIA going to tell us tomorrow? See, something that I posted about on ehack.com, and I want you to think about the ludicrousness of this. And it's just my opinion, okay? I know a lot of people like SMCI, but I see SMCI as a server rack company. They do server racks, switches, water cooling for switches, or for the server racks for the H100s. They do this sort of the infrastructure for chips. That's great. But much like lithium, when somebody makes a lot of money in one place, you invite a whole lot of competition. You just had one of the SoftBank sons say they want to start a $100 billion chip manufacturing and designing venture. You've got Sam Altman from OpenAI suggesting, oh yeah, we're going to raise trillions of dollars to manufacture chips. It's the same thing you saw in lithium. Lithium prices skyrocket. What happens after lithium prices skyrocket? You get people like Elon Musk on earnings calls that say, oh, you wanna basically print money, go start a lithium mine. And so what happens? People are like, oh, I want to print money, I'm gonna go start a lithium mine. And so it's a commodity. So what happens when prices go absolutely ridiculous for something? Everybody gets in at the same time as the growth rate slows and then the price collapses. This is very normal. It always happens. As price goes up, supply eventually catches up and prices collapse. It's very, very normal. So the thing that I found ludicrous this weekend was that Barclays wrote a piece that suggested, oh, super microcomputer? Oh yeah, baby. We have a $961 price target on this sucker. We're pricing this at 32 times 2025 EPS. And I'm like, bro, I literally wrote this. I go, yikes. I wrote this weekend. I'm like, it's a server rack company. And you literally have Wall Street analysts, Barclays, arguing, yes, let's give this server rack company a 32 times multiplier, not on today's PE ratio or on today's earnings, but rather on future earnings 18 months out. So we're going to go 18 months out, and then we're going to give them a 32 times multiplier. Like, no, they're not going to have that long-term growth. It all comes down to the growth rate, right? If this company is going to have a 30% growth rate for the 18 years out and then the next 4 years, that's okay. Then actually that would be a great deal. That's the way you have to think about this when it comes to PE ratios, always as a factor of growth. Always, always, always. Do not take PE ratios in isolation. So the way I like to do it is I like to take, maybe like the 6 month out. The 6 month out is usually like the end of the year, right? So you look at a company, like let's say we look at, pick Apple, okay? So we take Apple, and then what we're gonna do is we're gonna go, maybe 6 months out. So you go to grab the Q3 annual EPS figure. And then what we'll do is from that period, 6 months out, we're gonna look at about the next 4 years. And we're gonna try to understand what is the average growth rate over those next 4 years. And let's say it's 10%, okay? So then let's say earnings are, $20, okay? So earnings are $20 for the year ending Q3 2024. Let's just say we're making this up. And we're gonna sell for 10 times. Okay, we sell for a 10 times, that gives us a $200 stock and a PEG ratio of 1. In this example, these are not the real numbers for Apple, just saying that's because you're dividing by the average growth rate of 10. Well, in my opinion, anything under a PEG ratio of about 1.67, reasonable. 2 starts getting a little pricey. So the problem in the case of this server rack company is they only bring about 8% to the bottom line in net income. So you go 32 times, but wait a minute, you've already borrowed so much from the future. So 18 months down the road, how much growth is left after 18 months? Well, what if it's only 5% growth after that? It maybe the growth will keep going forever. Maybe. But what if it's only 5% growth? Well, then it's a 6 peg, right? And if it's a 6 peg and it's got to get down to say a 2, then the valuation has to collapse by 3-fold. So that's just an example, okay? So always when you hear PE ratio, think EPS growth rates. You look at, just to be, to play devil's advocate here, Tesla has a very high PE ratio when you look forward because of the anticipated growth. Is it as bad as SMCI? No. Why? Because you look at a company like Tesla, it's trading for $191. So go 191 divided by its end of the year price target. So that's about it's closer to 10 months ahead. So that puts you at about 62.6. Not going 2 years out, not going 18 months out, but you are going a year out in this, 10 months out in this case. So $3, 62.6 times. What's the growth rate projected on earnings per share thereafter? About 30%. Puts you at about a 2.1-ish peg, right? It shows you where the relative valuations are. The question, though, is what about a company like NVIDIA? Well, NVIDIA's got fantastic growth. When you look at 23, when you look at probably what's going to happen in 24, their growth is going to double, if not even 3x. Entirely possible. Fantastic adjustment. This is what we talked about in the AI's about to crash video. Yes, the growth is real. Everything's going to reset up. But what happens after everything's reset up? Well, then the growth rate substantially slows. So for example, we look at earnings per share today. We won't even go forward. We'll just look at earnings per share for what we're expecting to be reported tomorrow, $12.40. Let's say they beat and we get $13 of earnings. Okay, great. $13 of earnings. What's the PE ratio at $13 of earnings? Well, now that the price has come down a little bit, 686 divided by 13 puts you about 52.7 on a PE ratio. Okay, what's our forward growth trajectory for this company at a PE ratio of 52.76? Well, 116 divided by 4, 29, 52 divided by 29 puts you about 1.8. It's actually slightly better than Tesla. Keep that in mind. The question is, will growth be 29% over the next 4 years? See, if growth is half that over the next 4 years, and this is really where, as an investor, I want you to know, this is what makes an investor, okay? This is the difference. I want you to consider exactly this, okay? So, SMCI, people seem to be projecting 15 to 30% growth for this company. Okay. Then you look at NVIDIA, and we'll call this 1 year out. So call it we'll call it from end of 24. Okay, so from the end of this year. It's okay. It's okay to go to the end of the year. It's just, it gets a little funky when you start going, in my opinion, 18 months, 2 years, 3 years out. That's where things start getting a little funky. But anyway, so go from the end of the year. SMCI, 15 to 30% growth projected. NVIDIA, 29% growth projected. And then you look at a company like Tesla. This is on EPS. This is not on top line. It's on earnings per share. You're sitting at about 39%. These are all the Wall Street projections. Well, in my opinion, and this is how I'm positioning at least, and I have exposure to NVIDIA as well, though it makes sense to do a little bit of trimming probably before earnings. Maybe that made sense to do Friday afternoon, but hindsight's 2020. Who knows? Point is, SMCI, in my opinion, after you start getting competition for server racks and you start getting a normalization, you're not at 15 to 30% growth. Maybe you're at 5% growth. That's because, again, my opinion is that you go from AI, like no AI server, to having AI server. So this was no AI, right? You do not have, somebody left a comment on this. You do not have to transition no AI servers to AI servers. That is wrong. You don't do that. Just because you have storage doesn't mean you need AI on all your storage all of a sudden. All you're doing is you're going from no AI to you're adding the AI server rack. Well, now introduce competition and the fact that people have their racks. I could change out the boards without changing out the racks. So in my opinion, your growth goes down to say 5%. NVIDIA, after the explosive growth, honestly, even if it's still growing at 10% after the reset of this explosive growth, that's a win. Whereas then you have such low earnings for a company like Tesla. You're looking at earnings next year of $4. Okay, that's an assumption that gross margin will be 19.5%. And as interest rates come down, you wonder, what if that growth rate is actually substantially higher? I'll leave that as a question marker for a Tesla video. But that is the way to think about this. You don't have to invest like this. I'm not here to shill, so I don't really care how you invest. The point is, do we think that the server rack company is going to keep growing at these levels? Or are those Wall Street estimates way too optimistic? And based on what I'm seeing from Barclays, which goes into some of these average consensus estimates, way too optimistic. Again, I'm not anti the AI revolution. The AI revolution is absolutely here. I'm just anti the euphoria that's going into some of these plays. And I'm seeing the exact opposite sort of euphoria in interest rate sensitives, which makes sense because rates could stay higher for longer, as we've seen. But I'm also seeing the anti-euphoria in real estate. I think there's such huge, insane opportunities in real estate, specifically multifamily. I'll make a separate video on that. But if you wanted to know why not advertise these things that you told us here, I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate an actively managed ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than househack, nor am I presently acting as a market maker.